All right,
Okay.
we are live. So, or should I say live? We are recording. But anyway, I thank you for coming on. So, welcome everybody. This is going to be a quick recorded session with my CPA, Suzanne Eikel. She works with me and is pretty crypto savvy. So, I know something that a lot of people had questions about were the specifics of crypto taxes and everything. So, in addition to doing all of the technical analysis, etc., I wanted to bring Suzanne on and get some credible opinions from somebody who actually knows the tax laws. So, welcome, Suzanne. Thank you for making time and coming on the channel.
Well, thank you for having me. And hello, everyone. My name is Suzanne Eikel Pulaski, and I'm a certified public accountant. I've been working in the tax and business consulting world for over 25 years. A substantial part was with the Big Four, as well as with the Carlyle Group. In 2000, I left the corporate world to start my own practice and work with small to mid-sized companies and with high net worth individuals. What sets me apart from my colleague is I think outside the box and I find solutions with the tax code. That leads me to cryptocurrency. This is an industry which most accountants and lawyers don't understand and are too scared to realize it's just another form of investing. I commend all of those who take a chance and venture into this world of crypto, exploring new ways to invest and try to grow your business and personal wealth is exciting. With that in mind, let me try to answer questions that Cryptosomniac viewers have asked regarding the new tax laws. So I've been fortunate enough to receive a list of questions, and I'm
Yes.
going to go ahead and start tackling them.
Cool. Yeah, we just had I had polled a bunch of different members of our Moon Lounge, etc., for specific questions, and that's really where we started to realize how much lack of clarity there really is around how to pay taxes. I've heard a lot of different conflicting information, so very excited to have you on and be able to elaborate a little bit.
Well, thank you. I'm really excited. It's not just yourself, as you know, I work with you, but I also work with a lot of other people out there who have dabbled in cryptocurrency. Some are very well into cryptocurrency as being miners, so I have a whole league of different type of clients in this, and they've been in cryptocurrency since, I have some clients have been in it since the beginning when it first started.
Nice.
And so I've learned a lot about this industry, and it's been exciting to see the ups and the downs in this industry.
Sure.
So to me, it's an exciting industry. As I know, most of my colleagues think I'm absolutely nuts, but that's okay.
Well, and
So,
it's like the Warren Buffett line, right? Be greedy when others are fearful, and fearful when others are greedy. And I think all of us that are getting involved in the space now, obviously early adopters. Blockchain technology is definitely not going anywhere anytime soon, and I think people that are getting involved now and educating themselves now are doing themselves a real service for the future going forward.
Absolutely, absolutely. But on the other flip side, there's some good things that are happening, some bad things. There's a lot of controversy about the SEC stepping in and regulating.
Right.
I personally think it's a good thing because there's so many scams and fraud people out there. You can invest, and it turns out to be a company that really doesn't exist.
Yep.
And so I think with the SEC regulating the same way they do with a private placement, it's not they're not as invasive as it is if it was a publicly held company.
Right.
It's just you have to register your company. So I think there's a lot of myth about the fact that with ICOs, the SEC stepping in, and it really truly you just have to regulate as long as they're not going over certain limits in terms of raising. But it helps safeguard the investor, but you still have to do your due diligence.
Right.
But
I know there was a lot of FUD around just recently. They were very concerned. There was a big rumor going around. It turned out to be totally false, but everybody was very concerned that the SEC was going to be reviewing Ethereum specifically and saying that it was an unregistered security. And since so many other coins have been launched on the Ethereum platform, that would have been a nightmare. But it turns out to be not true. But there's a lot of fear around that, and
absolutely.
I've heard a lot of different things about. So a lot of people have asked me specifically about because we have a pretty active community of traders. So people aren't sure, is it first in, first out? I had heard somebody talk about the ability to say no. So say if I bought Bitcoin at 91.50 and then sold it 3 months later for 91.50, is that a wash? Is that still a taxable event? There's so much confusion around how to keep track of it. So we're hoping
so
you can educate us a little bit.
Yeah, so let's start. So at the very beginning, you have to think about it as it being a stock. It's so prior years, you didn't have to worry about it. Then in 2017, as everybody knows, the IRS started saying, whoa, wait a second, this is an industry that we're missing out on and getting tax revenue if you're a U.S. citizen. I'm not going to speak on other countries. I'm going to speak as if you're a U.S. citizen. Doesn't matter where you invest. You can invest overseas, you can invest here in the United States, but if you're a U.S. citizen required or you earn your income in the United States, and you are required to pay U.S. tax, these are the laws that you have to follow.
Right.
So it's basically the same way as if you have any type of stock. It follows basically the same rules now. So it's the first part you have to understand is your basis. And your basis is what money am I putting in to buy that investment? So what is my cost basis? And so that, you'll hear me talking about cost basis throughout this entire segment. So with the cost basis, then what a lot of people ask is, how do I determine what my cost basis is? So first of all, you have to make sure it's converted to US dollars.
Right.
And people invested 5 years ago, and now the tax laws start today, basically, or 2018 is when you have to really start regulating everything. So a lot of my clients have no idea what their investments were worth at the beginning. So that's one that you really need to talk to your tax advisor to figure out what cost basis should I be using. So it kind of goes from situation to situation. But starting 2018, you need to really start keeping track of what's my cost basis. I start with this in particular, whether it be a token, whether it be a coin, or whether it be some type of cryptocurrency. What is that cost basis at the beginning of when I started my investment, and then when I sell it, what am I selling it for? And again, a lot of the houses, when they download the information, it's all based on that cryptocurrency rates. Everything has to be converted to US dollars.
And so would it be best practice? So say for instance, right, like a lot of the exchanges, you can download a CSV that'll show you your trades. And so obviously when you're talking about like GDAX, which has a fiat pair for US dollar or euro or whatever, that's a fairly easy one. So would, say for instance, we're trading on like Bittrex and you download that CSV, it's only going to show you versus the Bitcoin value. So do you recommend when you're making trades, keeping track of the US dollar value of the Bitcoin at the time that you traded it for whichever altcoin it is, say the Cardano or whatever?
Yep, absolutely. And what I'm recommending to clients is, if they can, is, you can look up to see what the rate is, print that out if you can. Because if you ever get audited, you need to be able to show some kind of trail. And so I know that the IRS is going back and comparing everything to Bitcoin, but not everything is Bitcoin. They call everything Bitcoin, but everything's not Bitcoin.
Correct. Right.
It's becoming like the Kleenex,
or Q-tips,
it's tissue, but it's tissue.
Yeah.
There's a brand called brand called Kleenex. So Bitcoin is like Kleenex.
Yeah.
And so everything that you read in the IRS journals is talking about Bitcoin. So that's why I highly recommend, take a screenshot of that day of what that currency you have, what the US dollar conversion rate is, if you can. So that way you've got some kind of documentation to back it up. Again, the more documentation, the better, again, in case you get audited. Not saying you're going to, but you never know when you're going to be randomly selected for an audit.
And so would best practice be, say for instance, people are just figuring this out right now, right? And we're in the 4th month or the 5th month already of the year, and they've been going back and doing day trade. I mean, would it be acceptable, say for instance, like go back and look at coin market cap and find the Bitcoin value just on that day and record that as your best, closest estimate, I guess?
Right. So now you just referenced something very interesting. Day trade. There's some people who are out there trading, and they're trading hundreds or thousands of transactions a day.
Yeah, right.
I
trade in and out pretty regularly between fiat and Bitcoin, so And you know, a lot of people in our community are not only doing that, they're doing this across multiple exchanges with many different coins.
So that would be when you would really want to talk to a savvy advisor as to whether or not are you a day trader or are you considered just, you know, a random investor. There's a huge difference between that. And so, and there's some criteria because it might behoove someone to be considered, you know, a day trader because now it's a business. And if it's a business, you report that completely different than if it's just, you know, investments.
So you're saying gains and losses versus like a capital gains personal win and loss?
Right. That's one thing to keep in mind. So even though, you know, a lot of people want to they want to, you know, they do a lot of transactions and they want to take advantage of the capital gains tax rates, right? Because they're much lower. The thing is that if you do a substantial amount and if you got audited or even not audited, you turn this, you know, you turn in your information to IRS on Schedule D, and as if it's substantial, they could come back and say, you know, majority of your income, the majority of your wealth is derived from investments, not from a business, not from earning income. You could actually be considered a day trader. So it's one thing to keep in mind. So if you're doing a substantial amount, make sure you do seek some professional advice because you don't want to find out later on, by the way, you're considered a day trader. Because it's different tax rules.
Well, and I know capital gains is taxed differently, short-term versus long-term. I mean, again, I've only looked into this probably not as much as I should have, and yeah, I think it's like 39 or as high as 39% in the short term and the long term. So what is the determining factor that makes it a long-term capital gain? Is it just over a year, or is there other factors that play into it?
No, it's is that particular investment. So you have to look at every single investment individually to see is it long-term or short-term, and it's how long did you hold that investment. And then, so how long did you hold that coin or that cryptocurrency? How long did you hold that? And if you held it for 1 year or longer, then it's considered long-term. So most people, they're turning it very quickly.
Right.
So that would all be considered short-term.
Short-term, right.
Right, so if it's short-term, then it's considered, then the capital gains tax don't matter. So now the question is, if you're doing a high volume, and doesn't matter if you are doing investment or considered day trader, if you're doing a high volume, you're still going to be paying the same tax rate, right?
Right.
Because it's considered short-term. So now the question is, can you fit into the box of being a day trader? Because if you can fit in the box of day trader, now there's a lot of deductions that you can take to go against those gains.
Right. Okay.
So that it's like what I was saying before, thinking outside the box, doing everything legal with the tax code, but using the tax code to your benefit to say, okay, do I fit into that day trader box? I'm going to be paying short-term gains anyways on everything because I'm
trading in and out. Sure.
See?
Yeah.
So since I'm trading it and I'm, changing my positions on such a regular basis, it's going to be considered, short terms, which is at the regular tax rate.
Right.
Right?
Right.
So why not possibly be classifying yourself as a day trader and then take consideration all the different tax write-offs that you can have against that? Because it's considered a business.
And can you still make that sort of a claim if you say already have a full-time job? It'd be like operating a second business, or what are there any stipulations around that would prevent you from doing so?
There are certain rules that you have to follow behind that. So that's what I mean. So if that's the case and you're doing a massive amount of transactions, that's what I'm saying. Go seek some professional advice because that's now you have to take a look to see, okay, do I fit into the rule of saying I'm a day trader? Because there's all these different criteria you got to look at. It's not just a black and white answer.
Okay.
So, but I just want to throw that caveat out there for people to think, start letting everybody think outside the box about, here's the tax laws. It's not just, yes, I do all these transactions and I have to pay capital gains. There might be another way to look at your tax return that would be legal to allow you to have some more deductions against those gains.
That, which is ultimately what we're all trying to figure out, how to keep more of our gains and donate less to the IRS. You got to pay the tax man, but there's a lot of creative ways to work around what you got to pay the tax man. So we're always interested in exploring what those could be. I know I personally have never had a problem with paying taxes. I just wish there was a little more clarity of where it's going and how it's being spent.
Right. Well, that leads me to, so before we get to these questions, that leads me to some other tax strategy planning. So as you and I had talked about before, one area for people to think about is shifting some of their money into another account that would be considered a IRA, like a Roth IRA.
Right.
You switch it over to a Roth IRA, that if that money's already been taxed, and you switch to a Roth IRA, now you could take that money in that account and it can grow as much as you want, and you're not going to pay any tax on it. You have to follow the rules of Roth, but now it's going to grow and you're not going to pay any tax on those gains.
This is pretty clever. Like this whole idea is. I think there might be some legs to this, but and I know we were talking about this slightly before the call. So there's like custodial services you would need to go after, because I know there is. I've seen Bitcoin IRAs. I haven't looked too deeply into them because I've already got personally I've got a traditional and a Roth IRA, and so I was like, all right, well the IRA stuff's covered, and I'll just play the crypto game separately.
But now I want to rethink this through, because it's okay to have more than one Roth account, and it's okay to have more than one traditional IRA account. It's okay to have more. It's just that it's how much do you contribute in that year. So if you took the monies that you're going to do for the IRA, and you stick that into a whether it be traditional or Roth, depending upon which route you want to go. Let's say you take a 15,000 coins worth today, and you stick it into an account, and you play with that money. And like I said, if you do a Roth, it can keep growing, and it could grow as much as it wants, and you're not going to pay tax because you've already paid tax on that. Versus traditional IRA, you're taking that as a deduction today. So once it grows, again, you have to follow the rules. You cash it out and
pay the tax on the back end.
Right, exactly. Right. But you have to follow the rules of an IRA, which is great. Like if you're a college student, because you can pull that money out for first-time home buying.
Right.
You can pull that money out to pay medical health insurance in certain situations, but ultimately you're building your nest egg for retirement.
Yeah, and I know you can borrow against your 401k and things like that specifically for the home buying, and then you pay it back, but you are the one that gains the you're paying it with interest, but you keep the interest or something to that effect. So.
Right.
So so effectively, would you be doing a similar sort of thing, where you're borrowing from your 401k or rather, I'm sorry, from your IRA to be able to invest, and then you just have to pay it back with interest, or what? How does that?
That's the thing is, you can use that money to invest into your if you're a first-time home buyer, you can use money towards your first-time home buying. Period.
And so there may be some strategies there to be able to utilize that from crypto gains as well, and sort of like putting I'm trying to like conceptualize this in my brain, and it's almost like putting away some money into your FSA, right? So you're getting a more effective spend for your dollar. An FSA would be on your medical, but in this case, you're getting a more effective spend on your crypto.
Exactly. Well, and here's the irony of it, is that there's companies out there that you can set up your IRA with, or traditional. You can set up, but it's my understanding that you're kind of limited to what investments you do with them.
Sure.
If you're doing other investments,
list of funds or something that.
Right. Let's say you really want to get into some ICOs, and you want to start investing in those, and you can't do that. The limitations within the IRAs, because you have to go through a company. Like for example, Fidelity. You're going to be buying Fidelity investments.
Right.
There's houses that they'll allow you to buy certain things, and it's the crypto that they offer in their plans.
Right.
But if you want to invest in something outside the plan, what we were talking about earlier is doing what's called a self-directed IRA. With self-directed IRA, you pay a small fee, and then you can take that money and you can invest it anywhere you want. Like you can invest it like in an ICO, because an ICO,
and 10x gains rather than have to lock it up in it. Yeah, that's pretty clever.
Right. And here's the glory of it. It can grow and grow and grow, and you're not going to pay tax on it. Again, it's how you have it set up. If it's Roth funds, it's going to be set up where you can grow and you never pay tax. It's already been taxed.
Right.
Or if it's like traditional IRA funds, you're going to pay tax on that back end, so you're deferring those tax.
Right.
But you can invest. So an ICO is the same methodology as an IPO, which is a private placement.
Right.
And so you're investing, and so with that same methodology, that's how people can invest in these private placements. And a lot of people don't know this, but you can use IRA funds to invest in a private placement by going to a self-directed IRA. An ICO is the same way.
That's a really clever workaround, and also just being able to. I mean, this is all the financial game, right? Of just moving the money into the right places at the right time. I mean, it's sort of like a whole nother mental aspect of day trading, right? Because effectively, you're trying to acquire at the lowest price, let it go higher, sell, and reacquire at lower, so that you're constantly leveling up, and you're sort of building that into also being able to address it from a tax planning standpoint. That's pretty clever.
Right.
It's pretty clever.
Right. So like I have many clients who they do a lot of trading,
mm-hmm.
and I would say use your the money that you really want to gamble with. I mean, it could be you're not doing conservatively.
Right. You're aggressive funds. Right?
Play funds.
Yeah.
Do that in have like an IRA account. And again, I'm not an investment advisor. Okay, I'm just an accountant.
Yes. Right.
But it's like, and I just give them the ideas. You do what you want to do. I'm just giving you this idea. If you have your play funds and you're putting them into IPOs and it's going to do really well and you're going to make a huge amount of money, do that in your IRA account, because it can grow, and you're not going to pay the tax today.
It's pretty clever.
Like I said, it's going to be a deferred tax if it's a traditional IRA fund. So like if you rolled over your 401k, that would be considered traditional IRA funds if it hasn't been taxed yet.
Right.
But the funds have already been taxed, it's considered like a Roth funds.
Right. So I'm trying to think about that. I'm like, excuse me. I forgot my question. I'm trying to wrap my mind around this whole concept. That was the question I had. So if you say you had, let's just take Ethereum, right? So say you had put 2 ETH into an ICO, and you had done this out of this IRA that we're talking about. Is the amount that you pull out, and let's, for this example, say it's with Roth funds, right? So you'd already paid the taxes. When you pull it out, would there be no taxes at all, even on the gains? Right.
Oh, wow. That's the whole thing with Roth, because it's already been taxed. But again, you have to follow the rules of the Roth. You have to follow those tax rules, which means you can't just pull the money out when you want. You have to, there's certain criteria. It's either, when you reach the retirement age, you start taking distributions, or, you have to follow those rules at the time. But the glory of it is that many of the people that I know that are investing in it, this is money that they're not using today to live off of. This is money that they're doing because they plan on having the money in these accounts for a long period of time, trading and moving it around to see where it's going to end up going. And so if that's the case, it's something to think about is by diversifying it. Have some of it in your funds, that is your ordinary income funds that you will tax on, but start diverting some of it towards retirement. What we call retirement accounts. So
sure. The future money.
Yeah.
Yeah. Very cool.
It's all about deferring your taxes. Even though the tax laws are fabulous today.
Yeah.
Still, if you can defer something until tomorrow, why not?
Sure. Yeah. Or because hopefully things will be a little bit better in the future, and you can be able to continue to shell game it around and take advantage of it.
Right.
Well. Go ahead. Uh-oh.
And then also to remember, if you move, I was going to say, and also to keep in mind that if you so now that tax deduction will offset some of those gains that you made with your ordinary income.
Yeah, right.
Right.
this is great. This is this is super good information. I mean, and it's a lot of it. You know, a lot of people are just concerned about. Like I know specifically. So this actually sort of correlates. So I know specifically one of our members had asked about crypto gifting, right? So if they say say you bought a relative, let's just take a Bitcoin, right? And we'll say I think it's like $9,000 right now. I don't know. I don't have a chart up, but so if you gave somebody a Bitcoin today at $9,000 and by the end of the year it's worth 20, how does the tax implications work on that? For the giftee as well as the giftor.
Okay, so this is a really good question, and this is this is the same idea that one of the questions that was sent over by the one of your viewers.
Yeah.
And that is for gifting. Now I'm going to go into the realm of the gifting, the basic realm. There are some other ways around gifting that, again, you could talk to an advisor about, like if you want to do a 5-year plan.
Mm-hmm.
But if you are, but the basic gifting laws are, you can gift to a relative, to a family member, basically gift to anybody. And again, the laws for cryptocurrency have been redefined for 2018.
Right.
So you can do a charity and you can do a family friend up to $15,000, and it's a non-taxable transaction. So if the Bitcoin, I'm just going to use Bitcoin, if the cryptocurrency is worth, at the time of the gift, up to $15,000, it's a non-taxable event. Now, if my account is joint with my husband, my husband and I can do 15-15. That's $30,000 to our family or friend, or I'm going to talk about family and friend.
Yeah, sure.
Okay.
Right.
We can do 15-15. That's $30,000 to our family member.
Okay.
Now, if our family member is married, there's two. $30,000 to the wife, $30,000 to the husband.
Okay.
And if they had children, you could do $30,000 to each child. So you can gift that way, and it's a non-taxable event at that time. Now, non-taxable event for the giver.
Mm-hmm.
Now, the recipient, their tax basis would be the basis upon when they received it. So if it was worth, let's say my cryptocurrency to you was $15,000. I'm going to gift you today $15,000 of this coin.
Right.
Your cost basis is $15,000.
Right.
So then when you decide to sell it, doesn't mean at year end. Let's say you hold it, and you hold it for 2 years, and you sell it for $20,000. You have a long term, because more than 1 year you held it.
Right.
It's a long-term capital gain.
And thus it's the lower percentage. So
right.
And you're just paying the tax on the difference, right? You gave it to me at 15, so it's really only on, and then we say it's 20 after 2 years. It's just on the $5,000. Okay.
Right, because a lot of people don't understand that the basis that on the day of the gift transfers over to you.
Okay. Yeah, that was something I wasn't clear on as well.
Right, and a lot of people think that, well, at the end of the year, someone's got to pay tax on the gain. That was one of the questions, was, about the fact that it grew up to a certain point at the end of the year. Do I pay that tax?
Right.
No tax is owed until the person sells it. When the person sells it, that's when their basis will be the basis that was given.
Okay, that makes sense.
Yeah. And then they just report it as if it was their investment.
Right.
And the date they received it.
So I know specifically you had talked about you have some experience with some miners. That is something I know we have some miners in our community as well, cryptocurrency miners, not age miners. But we have some people that are. Yes, right. No, I don't think you're allowed to be in if you're under 18. You got to be at least 18 to be an investor, right? So.
But this age, I'll tell you, some of these kids are crafty,
that's for sure. There's probably tons of teenagers right now that are already so much more savvy with crypto than you and I put together, just because they grew up with it. But I suppose that's the nature of the beast. But anyway, so I know we have some miners, and so talk about that. Like, what is the cost basis there, right? So if I mined a Bitcoin and it's worth well, again, let's just round it off for the nice round number. So let's say, so I mine a Bitcoin by today. I'm rewarded a Bitcoin, and it's worth 10 grand. So do I have to pay tax on that now, because now I have this asset? And then also, does the cost of the energy that it took to produce this come out of it? How does that all work?
Okay, so it's a really good question. So it goes back to, like I was saying, with day traders, is that you have to keep track of all your investments, and which can be really mind-blowing with cryptocurrency, because you don't get the normal reports, and trying to figure out and convert everything to US dollars.
Yeah.
At least my experience has been with the thousands of transactions that they go through, and with mining, it's a completely different, it's a completely different method than if you're just trading coins. But every time you do a transaction, you need to know what the US dollars. Every time you buy and every time you sell, you have to keep track of the US dollars, of what that transaction is worth. Then at the end of the day, you calculate your gains. Well, it should be gains, but your overall, out of everything, out of your whole nest egg, what are the gains? And then you look at the gains, and you also have to look at how much money did they actually, physically receive out. Anyways, once you know what the total income is, that's considered income.
Okay.
And that's treated as ordinary income. Now, the next part of it is, since it's ordinary income, it's just like having your own business. Right. Now you deduct your expenses, which include the energy.
Okay. Yeah.
And you more likely
equipment, etc.
Right.
Potentially a portion of your rent if you're renting a space out to do your mining operation, etc.
Right. So, and then it goes into more tax laws, which is especially here in like if you're in California, or if you're in like New York, or any of these higher property value areas,
right?
Where you have caps on your property tax, which is capped at $10,000, and then mortgages, has a cap as well as to how much you can borrow. These are really good tax strategy planning, because now your property tax and your mortgage interest, you can split it between your home office and what's personal. So because you're capped at $10,000, if your property tax is more than that, now some of that's moved over to your Schedule C as your home office.
Clever. Very clever.
Yeah, so again, it's offsetting the income that you're making from your mining, or if you're doing day trading. So now, if you're mining, doesn't matter how much you do, what volume you do. If you're doing mining, it's automatically considered ordinary income.
Okay, just because you're basically generating something from nothing. I mean,
right.
Effectively.
Exactly.
Yeah.
Exactly. And then if you're doing trading in the forms of any type of cryptocurrency, just whether it be cryptocurrency or if it's tokens, coins, whatever it might be, that's considered capital gains. But again, based on the volume you're doing and how much of your income, your overall income's coming in, is it considered day trading, or is it just capital gains? Again, talk to a professional on that one. Because if you can slide it over to day trading, again, you're paying the ordinary income rate. But if it's short-term capital gains, you're paying that same rate anyways.
Right.
So you might as well be able to offset that against some of your expenses.
Is there like a rough ballpark threshold that you would need to, or like a percentage of your income that would qualify you for that, or would it just vary individual to individual?
It's gonna vary, because it depends upon what kind of work you do. If you're W-2, if you're independent. If you're independent, what do you do? Even if you're W-2, what kind of work do you do? So there's all these different parameters you have to look at, and then how much income are you deriving out of doing crypto versus your other job.
Job is okay.
Yeah, exactly. So those are all parameters to take a look at. But it's something just for people to be aware of. And now that leads me to another thing about forks, hard forks and soft forks.
Yeah.
Questions are asked all about time about, how do I treat those?
Oh yeah, perfect example. So like when Bitcoin forked back last year into Bitcoin and Bitcoin Cash, like I have a bunch of Bitcoin Cash I've just left it in a wallet because I haven't done anything with it. But I now have this asset that literally I did nothing for. So do I owe taxes on that, or would I owe taxes on that this year, or is that only if I sell it, or how does that work?
Right. So great question. So I get asked this question all the time. So basically, I like to use the analogy of you have a stock in a company, and that company now acquires another company, or they create another company, and they do a spin-off. And when they do a spin-off, to reward all their investors in the main company, they'll give you some stock. It's the same thing. So your cost basis stays with the original company, with those original stocks you have. In this case, those original coins. Whatever coins you have, your cost basis stays with that. But now the spin-off, which is the fork, those investments would have no cost basis, and you don't report anything until you sell them.
Okay.
And then when you sell them, it's 100% gain.
That makes sense, because
Again,
you didn't have anything to base the cost on prior.
Right.
Yeah.
Right.
Okay.
And now the question is it short term or long term? It depends upon how long you hold it. So you got to keep track of when did you receive it, and then when did you sell it? What is the U.S. What is the U.S. What is the U.S. basis? I mean, what's the U.S. dollar when you sold it, and then how long did you hold it? And if it's more than a year, it's at the long-term tax rate.
Okay.
For capital gains.
I suppose we should probably specify that obviously you are an American, and so primarily the tax laws that we are covering are going to be relating to American tax laws. So because we do actually have a pretty international audience, so I probably should have said something about that at the beginning, but in case that wasn't obvious now, I wanted to point that out, that this is all relating to American tax laws.
Actually, we did talk about at the very beginning. We were talking about the tax returns.
Yes.
And I said if you're responsible for paying U.S. tax.
Yeah,
we did talk about it.
Good.
So there's a disclaimer right there.
We got the disclaimer out.
We're just reminding everybody.
Yes.
We're just jumping
Right,
in.
again. And so, sorry guys, to everybody who is watching that is not in our American audience, I would love to hook you up with some knowledge on this, but I'm an American, my accountant's American, and so this is what value I can provide you in this area.
Right. So if you choose to do invest in USA, that's probably good for you to listen to as well.
Yeah, definitely.
Yeah.
So let's see, what else? What other questions do we have here? Well, let's talk about what happens about losses, right? Like, assuming, last year you could have pretty much closed your eyes and thrown a handful of darts and they all would have been bullseyes because, everything went crazy last year. But let's say that doesn't reoccur this year, and, maybe some people took a hit on some of the investments they made. I'm sure there was plenty of people still buying even Bitcoin and Ethereum back in January, February, when Bitcoin was near 20 and Ethereum was near 12. Those have since obviously cooled off. What about what's the deal on capital gain or capital losses, I guess is what that would be. Is there a maximum amount you can write off? How does that work? Because I had a lot of people, and sorry, I'm rallying like several questions in a row here. I had people asking me specifically about in December, like knowing, I bought this low, so now I've officially taken a loss on this, or I bought it high, so I've taken a loss, and if I sell it now, that'll give me, I'll just rebuy it tomorrow on January 1st or January 2nd, and then I've covered my gap. So talk to me about that a little bit. Dealing with losses if you take them, and then what is the best way forward? And is what I just stated even legal or possible? Be like, I'll sell at a loss today to claim the loss and then rebuy my position tomorrow. I believe that's frowned upon in the stock market.
No. Absolutely, people do that all the time. So what you talked about were two different issues.
Okay.
So I'm going to address each one separately. The first one is selling some investments, basically hedge off major gains. So if you had major gains during the year and you've got some investments that are in the finance world, a lot of times people call them dogs. They're not making any money. They're losers. They'll sell those to hedge against all those gains. So yes, that's legal. You can do that. Again, if you go back and you buy it within 30 days, it's considered a wash sale.
Okay, so that's what I was asking. Like, if I had Bitcoin and I sold it all on December 31st, while it was whatever it was then, like 17, and then you know, because I had bought 2 weeks before at 20, I sold it all at 17, and then I wait and I, you know, buy 3 days later after it had dipped back down to, you know, closer to 10. Is that, you know, I heard a lot of people being like, oh, I'm just going to do this and I'll get around the problem, but
no, so you have to, so you can sell things to hedge against it. Just keep in mind the 30-day rule for wash sales. But now you also talked about lawsuits. And this is one that, I mean, I've dealt with many clients and people asking is another popular question. What happens if I invest in a company or, you know, into a coin, I'm buying some cryptocurrency, I'm doing an ICO, whatever it might be.
Yeah.
It turns out to be fraud.
Yeah, there's a great, that's
very popular in this industry.
Unfortunately, it's happened. I mean, it's a number of bad actors have pulled ICO exit scams, basically. So
yes, that's a great way of saying it. I love that.
Yeah.
So, so what happens is that, again, you know, if you've got to make sure that you keep track of where am I putting my money. You know, this day I'm investing this amount of US dollars, this coin, into this company. Then once you find out that company is not a real company, you need to get some kind of documentation to support that. You can't just be your gut. You got to, you know, luckily the internet, it's amazing what you can find on the internet. Once someone finds out it's a scam, it's all over the internet. Just print some stuff out so you have some validation that it's not real. Especially the SEC, because now that if it's a U.S.-based company that's doing anything with cryptocurrency, they have to be registered.
Yep.
So if it's, you know, if they had followed those rules, then obviously the SEC would have something listed. But anyway, so get some type of documentation to support the fact that this investment is dead. It's completely dead. You lost your money. In that case, then, so let's say you put 10,000 into 123 crypto. Right. Okay, just hypothetical company. I don't know if it really exists, but
we'll say BitConnect, because that is a scam that actually did get shut down. Okay. So we'll use BitConnect.
Okay, BitConnect, so BitConnect. Yeah. Okay, so it's a scam. So you put $10,000 thinking that was going to be the hottest thing around. You put the money in, and then you find out it's a scam. So then what you need to do is print something out so you have a hard copy, right? So you've got something for your records to show if you ever get audited by the IRS that in fact this was a scam and I lost my money. Okay. So if you have that, now when you do your taxes, you indicate the fact that this is a date, you know, because you've got this printed out, so you should have a date on there of when you found out, not the date that actually went scam, the date you found out. Okay. The date that you found out that it was a bad investment, you lost your money, you can now claim that $10,000 on your taxes as a loss. Okay. Now, if you had the money invested and the date you found out was a year or more, it's a long-term loss. That long-term loss goes against long-term assets. And then again, if you don't have any long-term capital gains, then it goes against your short-term. Okay, but no matter what, you've got that loss to go against your gains. Got it. The reason why I'm specifying this is if it's a long-term loss, it goes against long-term gains. Right. If you utilize all those long-term gains, so let's say you have no gains, then it goes against your short-term. But if you had a lot of long-term and a lot of short-term, it's going to go against your long-term gains first. Okay. That makes sense. Right. So it behooves you that as soon as you find out it's a loser, print it out, have the documentation to prove it, because now if it's a short term, it's less than a year, it will go against your short-term gains first, which is what you want, because your short-term gains are taxed higher than your long-term. Right, yeah, totally makes sense. And that's why I'm specifying that end part. Yeah, that's good to know, because I wondered about that, or just even, you know, like I said, fortunately I didn't have any big losers. I had a few that were underperformers, but you know, long term it all ended up coming out in the wash, fortunately. But yeah, so I was just curious, you know, hopefully everything ends up in the positive direction at the end of this year. But always good to be prepared in the event that you do have to take an L, or you know, if you make a bad investment along the way. Hopefully the gains from your other stuff, it ends up being a wash on that. But it's good to know there's a little bit of recourse via the IRS as well.
in case.
But and also internationally too, because like I have one client, for example, and they invested in a coin that was in an Asian market, and somehow they lost his coins. So now it's worthless. And at the time that they lost it, it was, I'm just going to give an arbitrary number, 100,000.
Right.
That was worth at that time.
Right.
That lost. That's not what he put in, but that's how much it was worth at that time.
Right. The investment had gone to.
Right.
Yeah.
So he filed a claim with the company, with the government about registering the loss and so forth. So because to register, he recognized 100,000. Well, then when it came time to tax time, that coin has grown so much, it was actually worth $1 million.
Oh my goodness.
So he couldn't write off $1 million as a loss because
Right.
it was already claimed with paperwork to document at 100,000. So even at the end of the year, it was worth $1 million versus when you realize that during the year it was 100,000, you have to only claim the 100, you can't claim the $1 million.
I see. And it's not like you can say, okay, well, I'll only take the 100,000 right now, but now it's worth more later down the road. It's either or, right? I mean, you kind of,
right.
Yeah.
It's when you realize the loss. It's always when you realize the loss.
Okay.
So,
all right, good to know.
Which that really hurt because could have used that $1 million loss.
Yeah, I was going to say I would have much rather had $1 million write-off than a $100,000 write-off if I had to take a loss of that magnitude.
Okay, so now here's another question talking about losses. If, let's say, you just had a bad year and you had, $10,000 of losses.
Yeah.
I mean, in total, between all your gains and all your losses, it equates to a $10,000 loss.
Right.
Just to say hypothetically, okay? So you really are striking out bad with crypto. You're not
might be time to take a pause on the day trading action there, fella.
Because of all your gains and your losses from all your trades, it comes to a total of, let's say, $10,000 loss.
Okay.
$10,000 will not appear in your tax return as a loss. The maximum loss that you can take for capital losses on a tax return is $3,000. So then that $7,000 would be carried forward to the next year as the capital loss carry forward. And again, it's broken out between short term and long term.
Right.
That $7,000. They always take the short term first, right?
Sure. Yeah.
So then, it's broken up between short term and long term. It's carried forward to the next year, and that would be used against the gains, as we talked about before.
And assuming that would be carried forward year over year until it's all caught up, I guess.
Yep.
Okay.
Exactly.
I was like, well, that's convenient that they're just like, yeah, $3,000 is our stop loss, and then you're out of luck. We're not. Sorry, that's all we're going to cover you. I was like, well, that's okay. So it's just in a chunk. You can only write off $3,000, which I suppose helps the
IRS you can
stay
write the
solvent.
whole thing. But on your tax return on your 1040, the first page where it goes against ordinary income, the maximum loss that you can claim is $3,000.
Right. Okay.
So, and then any rest of the balance of your loss, overall loss, will then be carried over next year.
Okay.
So again, losses are going against gains, and then if your overall position is a loss, the maximum loss that you can claim against your ordinary income is $3,000.
Okay.
Any addition is then carried for the next year.
That makes sense. Yeah. Okay. Yeah, I was just, for a second, I was like, oh man, they just cut it off and then you're just out the difference. But yeah, no, that's good that you can roll it over year. Yeah. If you have to take a loss, hopefully, ideally, you've made good trades and you're not taking a loss that you got to roll over year. But
right.
All right.
Now that's not the case though. If you become a day trader, if you become a day trader, if you have a loss, it's just a loss that year, and then it's carried forward. If you have a huge loss, and it goes against all your ordinary incomes and everything. Bottom line, it's called your adjusted gross income on your first page of your 1040. So your overall tax position is a loss. That loss is then carried forward to the next year.
Okay.
Or you can carry it back to a previous tax return.
Oh, like if you had already had an outstanding balance that you were paying off or something like that. Okay.
Yeah.
All right, let's see. What other? I know we're coming up on the hour here, so I want to see if there's any other super important questions to squeeze in.
Another question that came up was on 1099Ks. I want to make sure we cover that.
Yeah.
A huge question is 1099Ks. People freak out because they're like, especially, was it Coin? I'm drawing a blank. What was that company that?
Coinbase.
Yes, thank you.
Yeah.
So they had to issue out 1099Ks, and it's becoming more popular and it's becoming a requirement by the IRS, not to worry. Again, if you've been keeping good records, your record should actually match the 1099 in terms of your sales. All it's reporting is your sales. You take that information onto your Schedule D if you're doing capital gains and losses, and you report it against your cost basis. So make sure you keep your cost basis. So just because that number might be big, that's just the revenue that was received in. That's not including your cost basis.
Yeah, I'd heard somebody that somebody got a notice. I think maybe I just read about this on Reddit or something, but somebody had gotten a notice from Coinbase that they had, well, because anytime you pull out more than 10K, they've got to notify, I mean, it's the KYC and AML laws, right? And it turns out, I think this person never had actually sold or bought. They had just, or not at least in this large of a sum, they had just had 10K in their account that they then transferred back into their bank, and they got the 1099. And we're like, I didn't make this 10K. What do I have to pay taxes? So that was where I had started thinking about that kind of question.
Yes. So in that situation, if the money is just sitting in a holding place, it's just sitting in a holding place, then it is not in an investment. It's just sitting in a holding place. Then if you're just moving it it's like bank account. If you're sitting in one bank account, you move it to another bank account. That's a non-taxable transaction. But if they invest it into an actual coin, then they have to know what the cost basis is and what they sold it for. The gains would then be reported. So it depends on on that situation you just talked about. If it was just in a holding place, like a bank account, that was a crypto bank per se, then it would be non-taxable if you moved it to another regular bank. So, but if you actually bought a coin, then it is a taxable transaction. Only if there was any, he has to just know what the basis is.
So here's that actually just made me think of another question, right? So for instance, we've got a number of employees, and a lot of them we just pay with crypto, right? And so as you know, to transfer a crypto transaction, it processes a network fee. So would that be something that would be able to be considered a business expense at the end of the year if we're from processing payroll that we add up the transaction fees, and we could potentially, so if there are other people that are paying employees with crypto, that the network fee to transfer the ETH, say for instance, would be something they could use for a business write-off?
Yep.
All right, sorry, it froze there.
Absolutely, and for day trading, if you're day trading, yeah, it's the same thing. All those fees are writable.
And so then, what about that just for personal users, right? Because you've got your funds that you're trading with on an exchange, and then if you're smart, you've got your long-term bags, is how we like to refer to them, in a cold storage, which would be a little wallet like this guy. But you can't set a stop loss through this, because unless this is plugged into a computer, it's the money's just effectively not plugged into the blockchain, for lack of a better way to say that. But basically, it's there. It's just it can't be transacted upon because the private keys are stored in the wallet. And now I've rambled with this explanation and forgotten what my point was.
I think on those fees for the wallet.
Oh, right. Yeah. So say for instance, because if I have my money on an exchange and I want to send it to the wallet, it's going to process a transaction fee to move it off of the exchange. What about those fees, right? And I mean, they're minimal, but over the year, it's going to be 30 cents here, 60 cents here that'll add up. So what about those?
So again, a day trader is part of doing business, right? Same thing with a business. If the business has a wallet, it's the same thing. It's part of doing business.
Okay.
But as an individual, again, as an individual, if you've got a cost of, just like think about this, if you have stock, and you have a transaction fee. So you're with, let's say, Merrill Lynch, and let's say you're doing TD Ameritrade, and they charge you X dollars. Let's say $15 every trade. That trade fee is part of the cost of the investment.
Okay.
Right? To get your money out.
Right.
So it's added back into your cost basis. All right. So every transaction fee that you do, that would be added back in as part of the cost basis, because that's the part of the cost of doing it. But in terms of a business, you would just add them all up, and that would just, because it's all part of doing business. Same thing with a day trader. Nice. You don't have to add it back into each investment. to show each one individually, right? You just have it as a fee.
That's really good. So I've been keeping track of that just because I was like, we probably would want to know this at least for operational purposes and budgeting. But yeah, the boys are going to be happy with me for keeping track of that one because that might be a additional write-off at the end of the year.
So. Okay, I'm glad I could help you.
Yeah, outstanding. Cool. Well, I don't know. Was there any other standout questions in there? Again, if you're willing to come on, I'd love to make this like a regular thing. It doesn't have to be all the time, but yeah, if we get you back on, that'd be great. But if there's anything else that was imperative to answer before we go, let me know.
Oh, absolutely. And so I'm going to do my own little pitch. If anybody has any further questions, or they would are seeking some more professional advice, please feel free to give me a call. You can reach me at 925, again, this is the USA number, 925-285-9504, or you can reach me at Eikel Financial Solutions at gmail.com.
And spell Eikel, just real quick. I'll have it in the titles, but just in case.
Oh, no, good point. Eikel.
Cool. Well, hey, Suzanne, thank you so much for coming on. And guys, yeah, definitely don't hesitate. This is my CPA. This is who I do business with. So obviously, I am vouching for her. And if you're looking for somebody who's savvy and you need some accounting help, especially in California, please reach out to Suzanne because obviously she's very knowledgeable and very friendly. So I recommend working with her. And Suzanne, again, thank you so much for coming on. Again, this is I watch a number of competitors' channels, and I've never seen anybody with anything like this. So I think this is a real value, and I hope our viewers think so. And I just want to say thank you so much. I really appreciate you coming on.
Absolutely, and I'm going to pitch one for you guys. If any of the viewers have any overall tax questions, go ahead and shoot them in to Jason, and I'll be next time we come on, I'll answer your questions.
Yeah. And if you're open to it, maybe we can do one of these live, like we go on, what we do on the show when we're doing the live charting and stuff. So maybe we'll do one where we have you come on and we'll have viewers actually live ask questions and stuff.
Perfect. Let's do it.
Awesome. All right, great. Well, hey, really looking forward to that. And again, thank you so much for coming on. And yeah.
Thank you. It's great. Thank you.
We'll talk with you soon.
All right. Take care. Bye-bye.
All right. Thanks.